Do you know it's possible to grow a small forex account from $10 right to $1,000? Trust me, this is 100% possible. Avoid others telling you that it's not possible to grow a small forex account. It's 100% possible provided that you follow these 5 simple things I'm going to share with you in this video. So hello guys, welcome to today's video. In this video I'm going to share with you 5 simple things you need to implement as a small forex account trader to be able to help you grow your small account up to any level you want it. This is actually possible, but you have to implement these 5 things first. So if this is your first time on this channel, welcome to my channel. Welcome to Paris Crypto and Forex. On this channel, I mainly focus on how you and I can make money through crypto and forex market. So if this sounds like you and need more videos like that, don't forget to smash that subscribe button, turn on the bell notification, and also join my Telegram channel as I go straight to today's video, sharing with you these 5 simple things you need to implement to help you grow a small forex account within a short period of time. So with that already said, let's get straight into today's video. So the first point when it comes to building a small forex account is simply focusing on only high probability trades. So what do I mean by high probability trade? So high probability trade is simply taking trade where you're 100%, where you're 80 to 90% sure that the trade will automatically goes your way no matter what happens in the market. This one thing we call high probability trade. So that's what literally differentiates forex trading from gambling, because in real time they look trading looks like gambling, but when it comes to understanding every single thing about trading, you realize that trading is far from gambling. Because when it comes to gambling, it's 50-50, whilst in trading it's not 50-50, because as long as you know what you are doing in the market, you cannot call trading gambling, because it's no longer a 50-50 game. So for example, what I refer to as high probability trade is taking a look at this screen here. So if you take a look at the market, you can see at this very level was where I wanted to enter the trade. You can see it here. So at this very level was where I wanted to enter the trade. But after calculating my profit to risk ratio of me using a 1 to 3 or 1 to 2 profit and risk ratio, I realized that if I should enter the market at this level, I would have been taken out when the market. So let me draw that part. So if I had entered the market at this level here, you see that the market would have taken me out when it got down here. So let me get my pen to actually make it easy for you to see. So let me just increase my brightness level on my computer. Okay. So for example, here's what we refer to as high probability trades. So brush through. So for example, I wanted to enter this trade at this very level here. You can see it here. But then after looking at my profit to risk ratio, if I had entered this trade here before, at this very level here, I would have been taken out of the market. So what did I do? I wait for this trade to fall back to this very level so I can get my high probability trading level. And when I entered the trade, I can see that automatically it went upwards without even facing down again. And this is what we refer to as high probability trading. You only look out for chances where you know that the trade is 100% sure for you to make profit before you enter. You don't just enter at every random zone. So that's the first tip here, simply focusing on high probability trading alone. If you are not sure about the trade, no. So hello guys, the point number 2 here is simply avoiding overtrading. So what do I mean by overtrading? So overtrading is simply entering multiple trades at a time when you know that you are trading a very small account. And that the worst thing you could do as an overtrader is simply using a high lot size. So back in 2021 when I started forex trading, the first thing that I actually did was that the reason why I blew up my first account was because I was entering multiple trades at a time and using a very high lot size. Though I won't blame myself totally then, because I did not take my time to learn everything about forex back then. But now I've learned every single thing I need to know to be able to do the market the right way, so I'm not afraid of anything again. So when you are trading a very small account, assuming your account is $100 or $10, you need to make sure that you don't enter multiple trades at a time. So you simply enter one single trade, and when that trade is going wrong, if you trust in your analytics, be patient and wait for it to come back to your position again. But if you don't trust in your analytics, then you have to use stop loss to make sure that when you hit a particular price target, it gets you out of the market without you losing your whole account. And this is one thing you need to implement, because when it comes to forex trading, one of the easiest way to blow up whether a big or small account is entering multiple trades at a time using high lot size. Because assuming all of the trade go wrong, then there's a high probability that your account might even run into debt, because your whole account balance will be liquidated and you're left with no option but to be among those saying forex is a scam or this and that. Because forex is never a scam. It's when you overtrade and you get your account bent out, that's when you see that forex becomes a scam. So my big advice to you is that even now that I'm trading a very bigger account, I don't even waste my trade entering multiple trades at a time. I enter only one single trade at a time and wait for that trade to come back into my position before I take my profit and then leave the market, then open any other trade if I want. And another thing you can do for yourself is simply having a daily price target that you want to make. All this one will help you overcome overtrading. So you simply said that, okay, on this day I want to make $2 or I want to lose $2. So once you make that $2 or lose that $2, you don't trade the whole of that day again. And this is another thing you can do to help you control your greed level. In this way, you'll be able to grow a very tiny forex account to get to any level you want. So that's simply it about the point number 2 is simply don't overtrade and always have a daily plan target. So the point number 3 is simply knowing how much you want to risk per trade, and this is really important as well. So if you are someone who is trading and you don't have any clear plan of that, how much are you going to lose per trade, how much are you willing to invest per trade, then there's high probability that you are never going to make even a single profit from trading. Trust me, this is the truth there. So when it comes to forex trading, you need to know your level of risk per trade, and one of my best advice is having a ratio of 1:2 or 1:3 per trade. So what do I mean by ratio of 1:2 or 1:3? The ratio simply means that if you are risking $100 per trade, your profit should be $200 to $300 in case you make profit, and this is what we call a profitable trading system. Not when you enter a trade, your risk and then your profit target is all the same. So now, how do I normally calculate my risk and profit target? So what I normally do is simply knowing how many pips I need to make my profit. So assuming I need 100 pips, I need a move of let me say 100 pips to make a profit, then I'll calculate, okay, so how much per pip am I willing to lose? So the price per pip totally depends on the lot size you are using. So in case you don't understand lot size, you can watch a video that will be linked down in this video description and also on the comment section. You can go watch it to learn more about understanding your lot size. So for example, if I'm using a standard lot, which is 1, every single movement of pip will represent $10. So I know that, okay, so for every single pip movement is $10. So how much am I willing to trade to make a profit of this? So I'm willing to lose, let me say $50. So I know that a 5 pip movement below my trade level will be $50 deducted from my account, and I'll got out of the trade. So this is simply how you understand it. And one of the easiest thing I use is Trading View. So let me show you how I can do it on Trading View. So when you're on Trading View, I normally use my position taker. So this one is for the long position. For example, I want to enter a trade here and I get my profit out of this very level here. So one thing I normally do is that once I enter it here, then I try to look at the size of this under here, the red part here. You can see it now. The size of this red part, then I multiply it to get this particular part of it. So if my profit is here, then this place divided by 2. So let me cut it into 2. So this place divided by 2 should be my risk level. So I'll just take this up to this level. Then I take this particular red side, then I go onto my MetaTrader or any place I'm going to place my trade. Then I simply mark out my take profit, my stop loss, and everything using this particular approach. And this one thing I love about using Trading View, I simply use to calculate my risk to profit level. So this one thing you need to do whenever you're trading. Always look at your risk to profit ratio and then make sure you're sure of it before you enter the trade and get to understand lot size very well. After this, the video on lot size will be tagged in this video description. The point number 4 is simply learning from your mistakes. So when it comes to trading, every single person make mistake. Even the top 1% best traders also make mistakes. So there's best thing to do as a beginner is simply trying to learn from every single mistake you make when you take a trade. Ask yourself why you lost that particular trade, and then try to figure out the reason why you literally lost that trade. So for example, one of the reasons why you could lose a trade is simply because 1, you did not enter the trade at the right time. So what do I mean by not entering the trade at the right time? So what I mean by not entering the trade at the right time is, for example, take a look at this current market right here. So let me delete this off. Let's take a look at this trade right here. One of the mistake you can make in this sort of market at this point is simply entering this market at this very top level as a buy market. So for example, you enter this market at this very level as a buy market, then it all of a sudden then turn backwards. So your mistake here could be because you entered at the wrong time or not being patient enough. And the second thing you can literally do is, assuming you enter the market at a very short point, like for example, you waited for this market to fall to this very level here. So let me just clean it up. So you waited for the market to fall to this very level here. Let me change the color of that level. So you waited for the market to fall to this very level, which is 90% sure that once it gets to this level, it's going to go upwards. But all of a sudden, it got to this level and then it did not go upwards. So what could be your mistake here? Your mistake here is not because you did not enter at the right time. It's simply because you did not know what was going on in the market at that very day. So this one simple hack that I always do whenever I want to enter a trade on Forex. I come over to this particular website. Let me share it with you. So that this website I normally go to, called MyFSbook. So this website is where I literally go to know what is happening in that particular pair that I want to trade on that very day. So assuming today I plan to trade a GBP JPY, and after analyzing the market, before I place my trade, I go over to this particular website and then go there to see why I should enter the trade and why I shouldn't enter this trade. And this is really important because this website will show you the news, high impact news that might affect your trading that very day. So if you had entered the trade the right time and then you did not look at the news, you are still likely to lose. So for example, come over here, you can see the news is over. You can see economic calendar. And then you can see that this one is high impact news on Australian dollar. So if you want to trade Australian dollar, then you take a look at this website. You can see anywhere you see this high here, you can see the high level here. Then you should know that this is a wrong time to enter this particular market, so you don't have to trade it. Take a look at this other one again, GBP on the pounds market. It's also under high impact news again. So what you literally do is open it up and then see how people are actually trading this market. For example, take a look at it. You can see they are selling, it's saying high impact news. And if you take a look, they say a higher than expected figure should be seen as a positive bullish market for GBP, JPY, lower than expected. So this one thing you need to understand. So after that, you come over to this down level here and look at the pairs. Look at the pairs that this particular market is actually struggling against. And one thing I love is that once you hover around the pair, they show you the percentage of people that have entered both the long and then the short market. So this one will help you make informed decision about that particular market to make sure that you are trading it at the right time. So the final tip here is simply do not withdraw whilst you are trading. So yes, the money is literally not yours because you have a plan that you want to grow your small account to a particular level. So why would you withdraw along the line? Because when you withdraw, you realize that you're not making any sort of progress, because assuming you made $20 in addition to the $10 you started with, and you withdraw the $20, you withdraw the whole of the $20, then you wake up, you realize that your account is still where you started from. So there's literally no profit, no progress. So the best thing I advise you to do is that no matter how you are tempted to withdraw that money, don't withdraw a dime from it. Be patient, trade with it until you hit that particular level. And another benefit of why you shouldn't withdraw is because, like, if you're able to grow a $10 account to $30, that's to tell you that you cannot increase your risk per trade level. Meaning, if you can increase your risk per trade level, it automatically means that you can increase the lot size you use, and that will also increase the profit you make per trade also. So the over time, once you keep going, you realize that you can start using higher lot size that will show you higher profit and help you hit your goal at a very faster pace. So that's really all about this video. Hope you find it helpful. Don't forget to smash that subscribe button, like this video, and tell me what you feel down in the comment section as well. So with that already said, have a nice day. Bye.